Hold on to your hats, investors. Have you been watching the stock market lately? Does it feel like you're on a roller coaster that just won't quit? Maybe you're sitting there, scratching your head, wondering if you should be jumping on the Nvidia bandwagon or if you've already missed the boat on AI stocks. Or perhaps you're that cautious investor thinking, is this another tech bubble waiting to burst? Well, you're not alone. Today, we're diving deep into these burning questions and more. We'll explore whether FOMO is back in the driver's seat, if it's time to just do it and buy, and which stocks might be worth your hard-earned cash in this wild market. Whether you're a seasoned trader or just dipping your toes into the investment waters, stick around. By the end of this video, you'll have a clearer picture of what's really going on in the market and how it might affect your portfolio. Trust us, you won't want to miss this.
Depressions are much more long-lasting, and people incorrectly assume that, gee, if a recession is 2 quarters of declining GDP, depression is worse. A depression must be 10 quarters of declining GDP, like a really long recession. And that's not the definition. You can have growth in a depression, but the point is it's depressed growth. In other words, it's growth below trend. For example, take the expansion from 10-year expansion from 2009 to 2019. The economy grew for 10 years. It was the longest expansion in US history, but it was also the weakest expansion in US history. Average annual growth was about 2.2%, and all recovery since 1980, average growth was 3.2%. So in other words, you were growing at a full percentage point less than the trend. And so it's that below trend growth, depressed growth relative to trend, that's what makes a depression. And that's what we're in now.
Before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's jump right in. Hey there, investors. It's an exciting day in the market, isn't it? Stocks are shooting up like they're on a rocket ship, and everyone's talking about FOMO, the fear of missing out. So what's the deal? Is it time to just do it? Should we be buying? And if so, what stocks are on our radar during this wild market ride? Let's kick things off by looking at the semiconductor sector. Check out the SMH index today. It's pulling a classic Nike swoosh move. You know, sharp dip, then swooping right back up. It's pretty textbook stuff. And speaking of swooshes, take a look at Nvidia. It's like they're saying, just do it, baby. Now, here's some juicy news about Nvidia. Word on the street is that the US is getting closer to giving them the green light to sell chips to Saudi Arabia. That's a big deal. It could open up a whole new market for them. All right, let's talk about the cool kids on the block, the Magnificent Seven, or the Cool Kids Club, as some like to call them. These are your top performing tech stocks that have been driving the market lately. And guess what? They're moving higher today. It's like FOMO on steroids out there. So what's causing all this FOMO? Well, let's break it down. First up, Nvidia's CEO, Jensen Huang, was at a Goldman Sachs conference talking about the crazy demand for AI chips. His exact words? We have very emotional customers today. Can you imagine? It's like Black Friday for tech companies out there.
Delivery of our components and our technology and our infrastructure and software is really emotional for people because it directly affects their revenues, it directly affects their competitiveness. And so we probably have more emotional customers today.
But wait, there's more. OpenAI, you know, the folks behind ChatGPT, are in talks for a funding round that could value them at over $150 billion. That's billion dollars with a B. And get this, just 2 weeks ago, they were valued at 100 billion. Talk about a growth spurt. But before we dive deeper, here's a quick question for you. If you could buy only one stock and hold it for the next decade, which would it be and why? Pause the video and drop your answer in the comments below. Let's see if we can spot the next big market winner together. Now, back to our market analysis. And here's the kicker. Even the big tech giants are feeling the FOMO. We're talking Nvidia, Apple, Microsoft. They're all throwing money at OpenAI. It's like they're afraid the AI train will leave the station without them. But hold your horses, because not everyone's buying the hype. Morgan Stanley's Mike Wilson is out there saying the AI theme might be overcooked. It's like he's the one person at the party saying, guys, maybe we've had enough. Now let's get a bit more technical and dig into some key market indicators. The S&P 500 is showing what we call a bullish engulfing daily candle today. It's back above its 50-day EMA, a sign of strength. But we don't stop there. Combining the 50-day EMA with the MACD crossover can help confirm if the trend is real. Look for the MACD line to cross above the signal line. If that happens, the rally is likely to continue. For extra confirmation, check the RSI. If it's below 70, it suggests that the stock isn't yet overbought. On the flip side, the Nasdaq 100 is approaching its 50-day moving average, but it's still in a downward channel. Use Bollinger Bands here to check for potential breakouts. If the price touches or moves outside the lower Bollinger Band and the RSI is below 30, it could be a buying signal. We've also got to talk about MACD and RSI. For those unfamiliar, the MACD is a momentum indicator that helps identify changes in a stock's strength or direction. When the MACD line crosses above the signal line, it usually signals that momentum is building. Pair that with the RSI. If the RSI is below 30, it indicates oversold conditions, and if above 70, overbought conditions. If both RSI and MACD suggest upward momentum, you might consider a long position. Using Bollinger Bands can help predict whether a stock is trading within its normal volatility range. If the stock moves outside the upper or lower bands, look for a reversion back to the mean. The narrowing of the bands, called a squeeze, often indicates a breakout, so watch for it in volatile stocks. Now, let's talk about some economic data stirring the pot. The Consumer Price Index, CPI, is down to 2.5% year over year, which is close to what the Fed wants to see. But don't get too comfortable just yet. Month over month, it's still a bit spicy at 0.3%. Watch for Fed meetings and pay attention to the yield curve, as these are critical for gauging long-term inflation expectations. A falling CPI could signal a dovish stance from the Fed, which is bullish for stocks. This is where the 50-day EMA or the MACD can help confirm if the market is reacting favorably to inflation data. So what does all this mean for us investors? Here's the scoop. First off, the stock market loves certainty more than a kid loves ice cream. As we get more clarity on inflation, jobs, and who's going to be running the show politically, we might see some big market moves. And as always, use the combination of moving averages, MACD, and RSI to assess trends. Secondly, this AI boom, it seems pretty real, but like any hot trend, don't let FOMO guide your decisions. Use RSI and MACD to confirm entry points and avoid buying into stocks that are already overbought. Lastly, and this is crucial, diversification is key. Sure, tech and AI are the cool kids right now, but don't forget about other sectors. It's like building a balanced meal. You need your veggies too, not just dessert. The table highlights some of the most exciting sectors driving the market today. Nvidia's 8% surge is a direct result of the high demand for AI chips, further bolstered by potential sales to Saudi Arabia. OpenAI, with its rapid rise to a $150 billion valuation, showcases just how powerful the AI wave has become, drawing in investments from major tech players like Microsoft and Apple. Meanwhile, solar stocks are quietly climbing, up by 6.3%, thanks to growing political support for renewable energy. While FOMO is pushing these sectors higher, each stock carries its own set of risks and rewards. It's crucial to weigh these factors and make informed decisions based on both market trends and your long-term strategy. All right, investors, we've covered a lot of ground today, but before you go, here's one last thought provoker for you. What's your boldest market prediction for the next 6 months? Bull run, bear market, or something completely unexpected? Share your crystal ball visions in the comments below. Who knows? You might just be the next market guru. Now, as we wrap up, I've got to remind you, investing always comes with risk. This video, it's for information only, not financial advice. Always do your homework and think about your own financial situation before making any moves in the market. If you found this breakdown helpful, don't forget to smash that like button, subscribe to our channel, and hit the notification bell. We're here every week breaking down the market so you don't have to. Thanks for tuning in to Simple Investing Secrets. Until next time, happy investing, and remember, stay curious, stay informed, and most importantly, stay invested.